Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zegel. Let's talk about not fighting the trend in the overall market when we're working with investments in retirement. And I'll back up a little bit to talk about planning in general. But first, really, this is about making sure we're not trying to do any drastic moves along the way. We want small adjustments, if anything. Often, if the market's gone up a whole lot, we'll hear people say, we got to get out of the market. It's crazy. It's super expensive. It's just going to crash. And conversely, not a lot of times, actually very few times, when the market's way down, we might hear somebody say, oh, man, we got to pour everything into the market right now and get it while it's really cheap. Now, the latter, when the market's down, we don't hear that as much because people get scared when the market goes down. But quite often we'll hear when the market goes way up, oh man, we got to get out. This is crazy, too expensive. It's just going to crash. Time to bounce. Time to get out of here. Let's save our cash. Usually, in most cases, there's very rarely an instance where you should make super dramatic moves. And we'll explain why here. First, let's back up to retirement planning in general and structuring the retirements. We talk about this all the time. We want to make sure that we have at least 5 years set aside out of the stock market, at least 5 years of income, your next 5 years of income out of the stock market set aside, so that way that money is safe. That way, when the market, not if, when the market does have a big decline, we're not stressing over it as much, because we know we have that income ready to go for the next 5 years, regardless of what the stock market does. We want to have that 5 years of income sitting aside in individual bonds, CDs, something that we know is going to give us that cash. Doesn't matter what the stock market's doing. We don't care. We just know that we have that money coming back to us from the individual bonds, from the CDs, and our income for the next 5 years, at least the next 5 years, is set. The stock market's going to have lots of ups and downs in that 5-year period. We don't have to stress quite as much because that is meant for the long term. With that as the background in the framing, then we can look a little bit more tactically, if we want to, on how to make adjustments to those stock fund positions for the long term. And the answer is rarely to make some big drastic move. When we're working with our clients and their investments, it's usually small little changes. Sometimes we'll hear, gosh, you guys make a lot of different trades. And it may look like that because you get some email notifications every so often of the trading activity. A lot of times it's just minor tweaks. So let's say a stock or a fund has a huge run. We actually did some of this morning as I'm talking about it. We had one stock that had gone up 30+% in a very short period of time. Did we sell all of it? No, it's not really necessary. You don't necessarily have to say, oh, well, it's way up, get out of it all. No. But you can trim a little bit, take a little bit of the profits off. So that way, if it does come sliding back down, you're not going, man, we missed out on locking that in. So take a little bit, make these little adjustments along the way if you want to. Never just say, oh man, I got to get out. I got to get out of everything, sell it all. This is way too expensive. This is the end. That historically has not paid off ever. Now, there's some times that are better than others, maybe before 2008, of course, that was kind of a rough slide. But even if you held through all of that, you still came out pretty darn well. So rarely has there ever been a case where the extreme move was the right move. The proper thing to do is set the planning structure up front so you have that foundation. Then you have the freedom to make smaller adjustments along the way. You can do so using options if you're really fancy with options. We'll do that sometimes. If something runs up real high, we'll do what's called a covered call so we can generate more income. I'm not going to get into all of that. The point being, don't do drastic stuff. Rarely does drastic stuff pay off. Instead, stay disciplined, have the structure in place, stay disciplined, and make minor adjustments along the way.